Hey, what's up, everyone? My name is the Smart Money Technician, and in today's video, we are going to be going through quarterly theory, daily bias, and entry techniques, navigating NFP weeks. Now, you know that with daily bias, we are basically trading a specific direction, but the days that we trade is very important. So when you are in an NFP week, the highest probability days to trade is on Monday, Tuesday, and Wednesday. Those are the three highest probability days to trade during the NFP week. And we will basically be getting into the video showing you how we navigate an NFP week. So as usual from the previous video, you know that the first thing that we do is that we want to identify the true week reversal. The true week reversal is two cracks in correlation, one of them being sequential SMT, the other one being either a TPD or a sequential SMT again. So over here on this chart, this is an NFP week that we will be looking at, and the previous week, because we are on the weekly time frame, we see that we had a weekly TPD. Now, this is not a traditional TPD that you are accustomed to, right? And the reason for this is that a traditional TPD is that we look at, this would be candle 1, this is candle 2, and this is candle 3. Candle 2 being the actual TPD, that's why I delineated with this arrow over here. And basically with a traditional TPD, you would look at the close of candle 1 and the open of candle 3 to look for a divergence. And as you can see over here, it's sloping lower. The close of candle 1 and the open of candle 3. As you can see over here, it is sloping lower. The close, right, of candle 1 and then the open of candle 3, as you can see, it's sloping lower. So all three of them are sloping lower. And you would say that this is not a TPD, but this is another kind of TPD, which is not a usual. So you may not come across this kind of TPD very frequently, but it is still a TPD. That's why I want you guys to know, so that in case you come across this kind of TPD, you are well informed. All right. So how is this a TPD? This is a kind of TPD that you are basically looking at the opening price of candle 1 and the opening price of candle 3. So over here, right, this right here would be the open of candle 1, and then this would also be the open of candle 3. And as you can see over here, it slopes upwards. If I drew an imaginary line from candle 1 to candle 3, we look at here, this would be the open of candle 1 and the open of candle number 3. If I draw an imaginary line, it's sloping downwards. This one is sloping upwards. This one over here is sloping downwards. So between these two assets, we can already see that there is a TPD, but we'll also look at here as well. Open price of candle 1, the open price of candle 3 slopes upwards. You see, slopes upwards over here, slopes downwards over here, slopes upwards over here, right? So we do have a TPD, and now you know the other kind of TPD. So let's get into the video. So you know that when we have a weekly TPD, we expect to see a monthly sequential SMT, all right? And that's exactly what we got. So the market gapped down at the opening of Sunday, and then it took out the previous week's low, but failed to do so in NQ, while it did so in ES and Dow Jones, right? Monthly sequential SMT. This sequential SMT is also confirmed by a 4-hour TPD, meaning that if we had just these two, the monthly sequential SMT and this TPD confirming it, we would have a true week reversal. But keep in mind that we also have that weekly time frame TPD as well. So that is 3 cracks in correlation, right? So that makes it even higher probability. And this happens during Sunday. So when we enter into Monday, we already know that we have our true week reversal, i.e. we already have our daily bias going into the day and even into the week. So how do we navigate Monday? We're obviously going to be looking for bullish trades. As you can see over here on Monday, this is nothing new. On the daily cycle, we have an SMT between the London and the New York session, right? So over here you can see, and if you look very closely, you can see that the lowest low is not really a swing low, it is more so just a candle. We still see that as sequential SMT. So you might say it didn't take out this low right here, but this low is not a part of the London session. It's this low right here, right? So price takes out that low and then it confirms it with a precision swing point or a TPD as you know it, right? So when you see that price gives you that TPD, and then on candle number 3, you see price trading below the low of the TPD, you can enter because you already have the sequential SMT, you have your true week reversal, you know exactly what you are anticipating for the day, right? So as price trades below it, you buy and take the range of that TPD, project it one standard deviation lower, and put your stop loss at the standard deviation low or just below it. And then you target a risk to reward of 1:3. And that is very simple. So as you can see, price easily trades in your direction after that. If you did not get this entry, there was a fair value gap over here, right? And the best thing that you can also do is to check if this fair value gap sometimes lines up with a new day or new week opening gap, then you can know that that fair value gap is higher probability to go in your direction. Now, if you are entering once you've seen a price is really expanded away and it is using this fair value gap as an entry, it's not wise to really target too much. Like you might not get a risk reward of 1:3, maybe just target 1:2 just to be safer because price has already moved from its origin. But let's look at Tuesday. As you know, Tuesday, nothing has changed, right? You know that once we have the expansion in our direction, we're looking for price to, on the higher time frame, consolidate or retrace, and then on the lower time frames, give us a crack in correlation, which is a sequential SMT, this time taking place on the 90-minute cycle. Now, I want you guys to study this. Anytime, for example, let's say you have your true week reversal, you have your anticipated direction, and then you get on the lower time frames a daily cycle sequential SMT. Usually the next day, if you are keeping the same bias and direction, you will not likely get another daily cycle sequential SMT. The next sequential SMT the next day is likely to take place on the 90-minute cycle, and that's exactly what happens here. So as you can see, we get a 90-minute cycle sequential SMT with a TPD, right? And you know, once you see candle number 3 trading below the low of the TPD first, you then buy below that low and take the range of the TPD projected one standard deviation lower and put your stop loss at the low of the standard deviation. Or if the TPD is pretty small, you might want to put it just below it in case price may do a deeper turtle soup on candle number 2. But as you can see, we are safe when we projected it one standard deviation, price did not reach it, and price eventually expands in our direction, right? And then if you also look very closely here, this was the second entry. So some of you that are more interested in trading the breaker and the fair value gap, you may not have gotten the entry because the entries were on TPD. So if you look at this candle over here, this candle is a TPD. Look at this over here. You can see this is a bullish candle, here it's a bearish candle. If you compare the close and the open of candle 1 to candle 3, you will see that this is indeed a TPD. So over here, as you see price trading above the high of the TPD, you can enter on a market execution and just put your stop loss below the low of the TPD as a continuation of the established trend that has followed suit. Okay, so that's what happens on Tuesday. This is why it's very important to do a whole lot of back testing, not just on the true week reversals, but on the entries. Because once you have known every possible kind of entry, these that take place, they will not be new to you and it is not going to catch you off guard. Okay, so that's the entry for Tuesday. As usual, as a day trader, you aim for a 1:3. Now, if you were trading on Monday where you caught the true week reversal, you could have held it till Wednesday. But as a day trader, we're just looking for a 1:3 and we are very content with that. So let's go to Wednesday, which is the last day we are looking to trade, right? Wednesday is the last day that we are looking to trade, and specifically Wednesday's New York session. So after the New York session of Wednesday, we will not look to trade until NFP comes out. So let's look at Wednesday. Again, now we have a daily cycle sequential SMT, nothing new, confirmed with a precision swing point or a TPD as you know it. So as you can see, the TPD forms and you enter in on the TPD, put your stop loss below the TPD, and you aim a 1:3. If you missed the TPD, there was a fair value gap here. But as you know, once you see price expand away from the TPD significantly and price trades back into a fair value gap, don't be too greedy to aim for a higher risk reward. 1:2 risk reward on these kind of entries are much more safer to target. So this is Wednesday's price action. Now, when we get into Thursday, I want you to look at Thursday. Does this look like high probability conditions? Yes, we had the true week reversal, and you may say, but that is high probability conditions. But you also need to take time into consideration. And as you can see over here, we have a consolidation coming in on the day that we are not supposed to trade during NFP week. So this is not a coincidence. So what do you take from this? Don't trade this. Trade this over here. Trade this over here and trade this over here. Avoid this. We are only going to trade if any after NFP comes out. I personally wouldn't be trading, especially if I got this, this, and this. I will be done for the week. But let's say you did not catch that many trades and you did want to trade. How would you trade NFP? You wait for NFP to come out and you basically have to know which direction. Now, I will say this. You see, as the market opened up here, this is where the market opened at the new week. That is the weekly opening price, right? Open. Anytime, right, you see that price significantly trades away from this opening price during Monday, Tuesday, and Wednesday, right? That's the first half of NFP week. The second half of NFP week is Thursday and Friday, meaning that on Thursday and Friday, you will expect and anticipate a trade back into the range if you see that price has traded significantly away from this price over here. You don't have to take my word for it. You can go and back test it for yourself if you don't believe me. But let's get into Friday. So on Friday, we had a daily TPD on the Thursday candle. The previous day was a daily TPD, right? So if you look closely there, you'll see that's a TPD. And then with that daily TPD, we also formed a monthly cycle sequential SMT. As you can see, we took out the previous week's high, right? So you can see that over here. That is enough already for a true week reversal because we have a daily TPD and we have a monthly cycle sequential SMT. But as you know it, anytime you get a daily TPD, what did I say in the previous video? You will expect a weekly cycle sequential SMT, which is what we get over here. So as you can see, we took out the high of Thursday, whereby in Dow Jones, we failed to take out the high of Thursday, weekly cycle sequential SMT. So we have three cracks in correlation: the daily TPD, the monthly sequential SMT, and the weekly sequential SMT. So that is enough for us to say that we have a true week reversal, right? As usual, the entries will be taken on the lower time frame and we will wait for a crack in correlation to form over there. So as usual, you wait for NFP to come out and you wait approximately 20 to 30 minutes after NFP. That is when you are only going to consider taking any trade. If the trade goes without you before that time frame has reached, then you leave it. The highest probability is 20 to 30 minutes after NFP has taken, because NFP is usually the false direction, like it likes to take people out on both sides of the range before it makes the real move. That's why you need to wait 20 to 30 minutes for NFP to come out before considering taking any entry. So let's see what happens. So as you can see over here, this candle right here that you see takes out both sides of the range. That's that candle that belongs to NFP. So it takes out both sides of the range, which is typical. And then it trades up one more time. And anytime that you see that on all three assets, we are above the high of the previous quarter, then you know that you are not going to expect a sequential SMT for that quarter, right? Therefore, the closest thing that you can anticipate is a TPD. And keep in mind, we already have that monthly and weekly sequential SMT supporting us. So if we get a TPD on the M15, then that's enough. But this would be considered a high risk entry, right? Because this is not accompanied with sequential SMT. Usually we like to see our entries with sequential SMT, but we don't in this case. So over here, this would be a high risk entry. If you took it, it would have worked out for you. But if you did not want to take this, you wait for price to do what? Give us a break of structure, forming a breaker and a fair value gap, which is what we get over here. So this would be the second entry. Now, anytime that you see price give you a long wick for your breaker, keep in mind that wicks are gaps. And over here, right, we have this long wick right here. So we're going to consider that as a gap. And over here, we do have an actual gap in price, which is a fair value gap. And it lines up with this long wick over here. This makes this area a balanced price range, right? Therefore, you don't have to put your stop loss above the high of the breaker, you can simply put it at the high of the balanced price range, and you will not expect price to go any higher than that. If it does, then it's a low probability trade, right? So your entry at the balanced price range, right? Stop loss above the high of the balanced price range, and you can now target a 1:3 because you have refined your entry. So it's more so about practicing the entry techniques. Once you have found all the sequences for the true wick reversal, the next step is to practice all the possible entries. Entries using the TPDs, entries using the break and the fair value gap, entries using the balanced price range. Once you know all of this, then you will have it very easy. The only thing that is going to be left is you combine this with the psychology to stick to your rules based on your backtesting and risk management so that you are not over risking your account and you are preserving capital. So with that being said, make sure you like, you comment, and subscribe if you enjoyed the video, and we will talk another time. Thank you very much. Peace out.